return on investment is a great way to evaluate our investments. There are definitely plenty of reasons to use ROI. The advantages, it does encourage managers to focus on the relationship between sales expenses and investment. So you're not just worried about one aspect. You really have to look at everything in total and how everything works together in order to calculate ROI. It does encourage managers to focus on cost efficiency because obviously to have a larger ROI, you need your operating income to be as high as possible. In order to have a higher income, you need to keep those costs down as low as possible. Same thing on efficiency of those operating assets. You want to be as efficient as possible with those assets. The lower the asset number, the higher the return on the investment is going to be. Now, there can be some disadvantages to using ROI to make your decisions. It can produce a narrow focus on divisional profitability at the expense of profitability at the overall company. So what I mean by that is, let's say, for example, you are a manager of a division, and your division currently has a return on investment of 20%, which is fantastic. Because you are doing such a great job, the regional manager has come to you and said, I'd really like you to take on this different division. I would like to move you over, or possibly even combine a second division for you to oversee. The only catch on you taking over that second division or that second investment is that investment only, let's say it only has an ROI of 12%. So if you were to accept the new investment, overall, the new ROI would be less than 20%, right? If you're currently operating at 20, you're taking on an additional investment at 12, the new return is going to be somewhere in the middle, which still may be great. Let's say the company says everything above 10 is good. So even though everything above 10% is good and you're going to be there, it's not as great as what you have right now. So managers definitely would sit and say, that's all right. I don't want to take on that new division. I don't want to be in charge of that new investment because it's going to decrease my return. That gives you something called sub-optimization. Like the manager, the division manager is looking out for him or herself. They're not looking out for the greater good of the company. So that's your downfall for using ROI. So another way to measure the investment centers is to use what we call residual income, and it is designed to avoid sub-optimization. So your formula for return on investment is to take your average operating assets and multiply it by a desired ROI. Basically, the companies are going to come out and say, we have a desired ROI of 10%, for example, or 12%, whatever the company comes up with. So if you take this desired ROI and you multiply it by the average operating assets, what this piece gives you is the amount of desired income. Okay, so if you take the desired ROI percent and multiply it by the average operating assets, what this gives you is the amount of desired income. Meaning if the asset earns this amount of income, it's good. So you're going to take this piece and compare it to the actual operating income. If the operating income is greater than the desired income, it's going to give you a positive number, and that's called residual income. And the residual income is the amount of income that is over and above what the minimum is. Okay, so you're going to have a minimum requirement. If the operating income is greater than that, that means you have extra. You're making income over and above what the company desires, which is a good thing. So as long as the residual income is a positive number, then that means that it is a good investment. It means that the investment is earning above and beyond the desired amount. So here's an example. Same numbers, same information as before. The only piece we've added in is now it tells you that the company requires a minimum rate of return of 12%, and we want to calculate residual income. So your formula, again, is operating income minus average operating assets times the desired ROI. We'll fill in what we know. Our average operating assets, again, are $300,000. So if I take 12% times $300,000. Okay, so if you do 12% times 300,000, what this gives you is $36,000. So $36,000, which is 12% times 300, 36,000 is the amount of desired income, basically. Meaning as long as you're earning 36,000, it's good. We're earning 48, so that's fantastic. That means we're earning $12,000 more than what the company says is a minimum or what their desired amount is. So having a positive residual income number is great. We're earning $12,000 more than what we desire. So that's good. So that would be definitely very favorable. So that is how residual income is going to work. Now, to put just a small twist on residual income, we can calculate what we call the EVA, economic value added. There's only a small difference in the formula for EVA versus residual income. So you'll notice that instead of using operating income, we're going to use net income. So net income is going to be your income after you take income tax into consideration. So you have net income, and then your cost of capital is going to be a different rate. It's going to, the company will give us this amount. The problems will tell you what the cost of the capital is, and then times that investment piece. So it's just a small little different wrinkle on your EVA. Another topic with regards to decentralization is what we call transfer pricing. In many decentralized organizations, the output of one division is used as the input of another. So for example, let's say you have Sony, and Sony manufactures batteries, and maybe the batteries need to be used in a computer that they also produce. So the battery is going to have its own division, right? So the battery division is going to have revenues, it's going to have expenses. The battery division is going to have net income. The computer division is going to show revenues and expenses and net income. So that's what is known as a segmented income statement. Okay, so the battery division and the computer division are each going to have net income. So the manager of the batteries wants it to be as profitable as possible. The manager of the computer division wants to be as profitable as possible. And so here is your issue. The computer division needs the batteries from the battery division, but it's all part of the same company, which is Sony. So what happens is you have to come up with what we call a transfer price. So in essence, the battery division, quote unquote, sells batteries to the computer division. So the battery division is going to show some revenue on their segmented income statement. The computer division is going to show an expense on their portion of the segmented income statement. So what amount of revenue needs to be there versus what expense needs to be there, you have to put a dollar amount on there. And that's what's known as the transfer price. So it's the price charged for a component by a selling division, which would be our battery division, to the buying division, which is the computer division, all within the same company. Again, it is going to affect the profits of both divisions. So there are 3 different transfer pricing policies. The first transfer price policy is called the market price. Basically, the market price is the price that you want to use if there's a competitive outside market for the transferred product. Okay, so if Sony can sell, the battery division can sell those batteries to outside people, then the market price is whatever they sell it for. What's basically, best way to think of it is fair market value. Okay, so that would be the market price. Now, it could be that the batteries can only be used in this computer, right? So if the batteries could only be used in this computer, that means that there is no market price. Okay, so if there's no other outside buyers, if all the batteries you're good for is the computer that we're also producing, then you may have to use what we call the cost. Okay, so you would just use the cost of the battery if there's no good outside price. The third option is what we call a negotiated transfer price. This approach is particularly useful in cases with market imperfection, such as the ability of an in-house division to avoid selling and distribution costs. that the external market participants would have to incur. So basically, if you use a negotiated price, it's going to be somewhere between, fair market value or market and cost. Okay, so it would typically be somewhere between market and cost. So the negotiated price could be okay. But again, the market price is preferable if it works. If there is a good, outside market, then that's the best price that you would want to use. And that brings us to the end of chapter 12. If you have any questions over any of the concepts in this chapter, please let me know.